Craig, we're going to talk all things to cut or not to cut, to issue duration or less duration. What's the story? I want to know the pros and cons and what you think is going to happen next week.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Yeah, next week is the Super Bowl of macro to start 2024, precedes the actual Super Bowl, which is the following weekend. But look, last week, Friday was expiry, and we talked about how the window of weakness after positioning got cleaned up a bit, was open for macro to matter more than flows. And that is playing out, and next week will be that in full effect. And the offset or the caveat to that is that we are in the midst of earnings season as well. Mm-hmm. So you have this dynamic where every day different companies are reporting and blowing up or blowing numbers out. Netflix blew it out, Tesla blew up. Sounds like right now Intel is blowing up. And
that was kind of expected. Okay.
And then next week, it's the Super Bowl of earnings too. It's Microsoft and Google on Tuesday afternoon, Apple and Amazon on Thursday. That sandwiches the Fed and Treasury on Wednesday. We also have payrolls on Friday, ISM on Thursday. It's going to be, it's a lot. It's a lot.
But positioning matters into this macro driven event. And we got a lot of mixed signals there. So is it easy to ignore all the earnings stuff or non-farm payrolls? No, but we need to for Wednesday.
Yeah. And look, I put it in the chat today, but some of my overbought, oversold signals, are screaming red. Nvidia.
What sectors are screaming?
XLC is in the XLC, which is basically Meta and Google, is in the 99.7 percentile. Nvidia is 99th percentile. So we have traveled far into next week, and expectations obviously are high for earnings. They are high for Fed rate cuts. They are high for Yellen to deliver more bills than bonds. They're high for, expectations are high for tomorrow too, that the PCE is going to come in very soft. So it seems like we have priced in a Goldilocks scenario, and it doesn't mean that we're not going to be delivered that scenario. It just means a lot of it's already priced in here, is in my view. And so the way the macro calendar kind of plays out is tomorrow is the PCE. And after today's GDP print and core PCE, we have an idea about what that's going to be. Basically, the survey is at 0.2% month on month for the core deflator. And that seems like it's going to be, what it will be after today's data. You kind of can back into what this is going to be. Now, the question will be, what does the super core look like? Does that come in hotter than expected or cooler than expected? Is it 0.15, which rounds to 2.2? Is it 0.24, which rounds down to 2? I know it sounds ridiculous, but I think the way the market is pricing, really the expectations are for a soft print tomorrow. So there is some risk that
quarterly, the semi-annual, the annual. We're not going to get to 2%.
Yeah, look, it's really just a question of what we're trying to ascertain is whether or not the Fed is ready to begin its rate cutting cycle as soon as March, simply because the 6-month annualized core PCE is now would be down to 2%. And so many people believe that is enough. The odds are basically 50-50 at this point. They're down from, they were close to 100% odds of a March cut to end the year. They're basically down to 50-50. And so, the question is, after such a strong GDP print that we saw today for the fourth quarter, which followed on an even stronger GDP print for the third quarter, is the Fed really in a rush to start the rate cutting cycle in March? Or does this data kind of provide them enough flexibility to hold off, wait until May, wait until June? Why upset the apple cart here? There's really no signs of an imminent growth deceleration here. I mean, it's clear that the loosening of financial conditions to end the year helped the economy at the end of the year. The December data is coming in better than expected. We saw a flash PMI print for December was very strong. So, it seems like the Fed should be happy with what they've done and no reason to intonate that it's time for the rate cutting cycle to begin as soon as March. And the reason that they don't, or I suspect that they wouldn't want to do that, would be it's inflation expectations have started to move higher across all durations, and oil is starting to break out a bit from where it's traded over the course of the last six weeks. There's clearly supply chain disruptions that are on the horizon. The supply chain indexes are starting to move back higher again. That's the disruption indexes that the New York Fed has and other folks now have because of the Red Sea shutdowns and the Panama Canal issues. So obviously the geopolitical stuff is still a concern. More talk now also of China possibly stimulating, which could be inflationary. So look, I think there's a lot brewing that could lead to a stronger inflationary environment as we push through the year. So if you're the Fed, you say, we have let's not add more fuel to the fire. Let's hold off. That would be what I think how they're going to approach it. We'll see how, when he's prompted with the question on Wednesday, how Powell deals with that. The other thing that we still, I think, need to deal with is this idea of financial conditions versus real rates. So the Fed, the argument for the Fed cutting rates is this real rates normalization idea, which says that as inflation falls, if you don't cut rates, then you are becoming even more restrictive because real rates would be rising. The counter to that would be, even though real rates have been rising, GDP in the second half of 2023 annualized at 4%, and there's really no indication that the economy is really slowing down materially from this tightening regime. Financial conditions are as loose as they've been across a variety of metrics, as loose as they've been since the beginning of the tightening cycle. And this is something that Lori Logan talked about in her speech, which is, if financial conditions continue to loosen, it's going to be harder for us to keep inflation down at 2%, which is something that Waller said as well. It's not that the Fed is just trying to achieve 2%. They want inflation to stay down at 2% for a sustainable period of time. It's not a one touch and done type thing. So if financial conditions are too loose, the odds that inflation will reaccelerate in the back half of this year start to move higher, in which case then that's not mission accomplished. So I think push comes to shove, next week, Powell, doesn't really, he'll say he's data dependent. I don't think they're going to make any moves on the balance sheet to be announced at this meeting. I think when he's asked the question about the balance sheet and tapering, he's likely to say it's up, yes, we are discussing the pace, but we have nothing further really to report on that at this time. The BTFP facility is being wound down, but there's still a year left on that facility. If as long as you borrow money, you have a year to pay it back. So it's not an imminent crisis for regional banks to find the hole for that financing. So I think Powell wants to get out of this meeting with a, hey, we're doing a great job. We don't look for us to, provide a lot more stimulus here at this point. And market do what you want with that. You want to cut price in 6 cuts for next year. We probably aren't going to get there, but that's what you're going to do. That's what you're going to do. We're not aggressively pushing back or pushing in favor in one direction. So that's I think the setup for Wednesday afternoon. The question then is, how does the Treasury announcement factor into how the market will trade the Fed? And I think that's, again, it's TBD. I mean, there is strong, I think, evidence for Yellen here to use this next QRA announcement, which will provide the data for issuance of duration and bills for the second quarter. This is an opportunity for her to once again issue duration, which she has already said that they need to do one more time. Term premiums are negative. If you think the Fed is going to be cutting more aggressively in the second half of this year than the first half of this year, again, that makes you think that, well, I should issue less bills now at these high rates, and I should issue more bills later when the rates are lower. There is, politically, I think people believe that Yellen is a political animal and that all she cares about is, Biden being reelected, and so she'll do whatever it takes to make that the case. And I think that's hard to say. I mean, it's, the Treasury has stated goals and intentions about, how they finance the government's balance sheet. They know that the deficits are as big as can be and grow every year. I don't know. To me, it just doesn't seem like a time with the S&P flirting with 5,000 and yields having, fallen close to 100 basis points since when she last announced the QRA. Why she wouldn't use this as an opportunity to push the pendulum back the other direction again. Obviously, we'll wait and see. I think the evidence suggests that she should, but we'll be able to see first on Monday afternoon, but more importantly on Wednesday morning, kind of what she decides. The decision on Monday afternoon is the amount of total issuance that will be needed in the first quarter and the second quarter, as well as the closing levels of the Treasury general account for the first and second quarter. So if the deficits have been running bigger than expected, which I think they have been, there is risk that she will, no matter what, have to announce that more borrowing will be needed for the first quarter. That would be at Monday at 3:00. And then Wednesday at 8:30, the composition bills versus bonds will be announced. In the first quarter, we're looking at, 350 billion or so net duration issuance. For the second quarter, if she announces something that's reasonably higher than that, I think that is something that the market will say, okay, this is an issue, more duration. We may start to need to trade like we did after the second quarter QRA. So that August, September period where bonds sold off and risk kind of came off. But we'll have to be more reactive than proactive here. We'll have to just really see what she says, because there is a political component to this that is very difficult to handicap.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.